Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta. It's the 19th of July 2023 and here are the top stories for the day. What does multidimensional poverty report mean for India? Why has the government's privatization drive stalled? Will stocks of gold jewellery retailers sustain their rally? And what are sponge cities? India pulled out 135 million people out of multidimensional poverty in 5 years between 2015-16 to 2019-21. Niti Aayog said this in a recent report. The portion of the poor in the country has now come down to 14.9% from 24.8% earlier. So what does this dip in poverty mean for the country's economy? Shiva Rajora and Bhaswar Kumar do a reality check.
The latest National Multidimensional Poverty Index or MPI was released on July 17th by the Niti Aayog. It said that as many as 135 million people in India escaped multidimensional poverty in 5 years, between 2015-16 to 2019-21. The latest index, which is based on the National Family Health Survey 5 or NFHS 5 data, shows that the share of multidimensional poor people in the Indian population has undergone a sharp decline to 14.96% in 2019-21 from 24.85% in 2015-16. Rural areas witnessed a faster rate of decline in the incidence of multidimensional poverty, from 32.59% in 2015-16 to 19.28% in 2019-21. The index by the Niti Aayog measures and compares deprivations directly across 3 components: health, education, and living standards, which are represented by 12 Sustainable Development Goals aligned indicators such as nutrition, child and adolescent mortality, maternal health, years of schooling, school attendance, cooking fuel, among other things. The steepest reduction in the proportion of multidimensional poverty was observed in Uttar Pradesh, where 34.3 million people escaped multidimensional poverty, followed by Bihar, Madhya Pradesh, Rajasthan and West Bengal. The report also says that India's MPI value nearly halved from 0.117 to 0.066 in the same time period, and the intensity of poverty reduced from 47% to 44%. Thereby setting India on the path of achieving the SDG target 1.2, which is reducing multidimensional poverty by at least half, much ahead of the stipulated timeline of 2030. The Niti Aayog's report comes a week after the UNDP and the Oxford Poverty and Human Development Initiative released the latest global MPI, which showed that 415 million people moved out of multidimensional poverty in India in 15 years, from 2005-06 to 2019-21, with the incidence ratio falling from 55.1% to 16.4%. So, what are the likely implications of this drop in multidimensional poverty on the larger Indian economy?
It's a positive sign, but it does not really tell us anything in terms of the income part of the people, because most of this is in terms of what has been delivered. It's not in terms of the income which has been generated, which is the second stage which is required, which can happen only when we are able to create more jobs. I think the pace at which we go into the second phase is going to be much slower than what we have seen, because we'll have to distinguish between the supply side and the demand side. When I say supply side, the government has a certain program. It had promised to do certain things which have been done very well. So that is why we are seeing that every household has access to a number of amenities. So when you're talking multidimensional, we're moving away from the earlier system where we spoke in terms of the calories which are being taken, or when you're talking in terms of the income which is being earned. So we're not really talking too much about that. Now, for jobs to be created, I think there's very limited thing which the government can do, and it is created more in the private sector, especially when you're talking of urban India. Since this period also covers the COVID time when we had lockdown, that was the phase where the government had actually given free food to 800 million people. This is official data. So if 800 million people had to depend on the government for free food, it means that while they had these amenities, they did not really have the power to buy food on their own.
The global MPI in 2005-06 had told us that 645 million people were in India were poor. And over the next 10 years, by NFHS 4, by 2015-16, when this current government was just starting to function, that number had fallen dramatically to 370 million. That was a real halving over a 10-year period. And let's just remember that over that period, we also have the statistics for actual consumption or income poor. Because not only was the growth rate of the economy 8% per annum, which we've not achieved since then, since 14, but we pulled some 140 million people above the Tendulkar poverty line in a matter of 7 years. In this latest period, 5-year period, I did a double check on this 135 million number. Actually, even this is not correct. There is a reason for that. And this is a revelation I think I want to make on your Business Standard show. It is the following, that they have misestimated the projected population for 2015-16 and considered the population for 1920 as the same as in 15-16. How can that be humanly possible? Every year we add at least 13 to 14 million people to our population. That means over that 5-year period, we added 65 million people to our population. So, in fact, when you do use the correct projected population for 15-16 and not the same population as prevailed in 1920 for 15-16, then you get a much smaller a reduction of the people below, falling below MPI from 135 million, as the government is claiming in this report, Niti report, to 118 million. Now you ask, what has all this got to do with the larger economy? I think one connection with the larger economy I've already pointed out. Per capita incomes rose much, much faster earlier and that was the reason why income poverty declined dramatically. We have no evidence to suggest that income poverty has declined. If anything, the opposite, because joblessness was its highest in 2017 and it has only worsened since then, and wage rates have been consistently falling. So there are real concerns.
While we cannot confirm that the numbers are incorrect, the experts agree that the provision of services like electricity and drinking water by the government is a positive. However, they point out that income poverty and employment creation remain significant concerns for the Indian economy that the claims of this report do little to assuage.
But these government schemes, which have lifted millions out of poverty, come at a cost. They put extra burden on the exchequer, forcing the government to look for ways to replenish it. Privatization of state-owned assets was one of the avenues through which it would have raised capital. But, barring Air India, the country has not seen any major sale of any state-owned asset. So why has the government's privatization drive stalled? Tariq Ahmed brings you the answer. On October 8, 2021, the government finally announced the sale of Air India to its original owner, Tata Sons. It was the first privatization of a state-owned company in 17 years. Since then, there has been no big news on that front. There was no mention of disinvestment of any state asset in this year's Union Budget speech of Finance Minister Nirmala Sitharaman. It came as a surprise for many, as the BJP government had been vocal about privatization. Between 1999 and 2004, the then Atal Bihari Vajpayee government had sold 12 PSUs, despite strong opposition from within the government. Prime Minister Narendra Modi too, soon after coming to power, had said that the government has no business being in business. Between 2014 and 2019, the government did raise some capital by merging PSUs. In 2017-18, ONGC acquired government's 51% stake in HPCL for 36,900 crore rupees and helped DIPAM garner a record 1 trillion rupees in divestment proceeds. In her 2021-22 budget speech, Finance Minister Nirmala Sitharaman had announced plans to put IDBI Bank, 2 public sector banks, and a general insurance company under the hammer. The government also had plans to privatize Concorp, Shipping Corp, Pawan Hans, Central Electronics Limited, BEML, and others. But hardly any progress has been made in most of the cases. For the current fiscal year, the disinvestment target is pegged at just 51,000 crore rupees. The privatization effort of BPCL, which would have been India's largest privatization deal, was called off in May due to lack of bidders. In 2020, the Indian government had announced its biggest ever asset sales plan of about 2.1 trillion rupees. But due to COVID and other factors, only 16% of the target was met by the end of the year. So why has the government's privatization drive hit the slow lane?
So we should see privatization as a way of building a more competitive Indian industry and not just as something that will raise revenue. I think it's disappointing that the privatization program has essentially come to a halt. It seems like there isn't the ambition to go ahead with privatization. I know we're coming into an election year, but there's no good reason why we haven't seen progress on privatization in the last 2 years.
2 of India's biggest companies, Vedanta Limited and Adani Group, who were also interested in buying Container Corporation Limited and NDMC Steel Limited, have been facing problems lately. Due to setbacks, both the companies have shifted their priorities to paying back their debts from acquiring new assets. Experts said that despite the increased GST collection, the slowdown in privatization efforts have affected the revenue of the government.
Presently, the subsidies, because a lot of petroleum subsidies have been taken away, and there has been a exponential rise in the GST collection. So that is filling up the buckets of the government. But yes, if because these divestments were planned for further investment into infrastructure, that bracket would have a deficit for sure.
So what can be done to catalyze the privatization drive in India?
In the meanwhile, probably some structural changes in the PSU functioning that needs to be done. Maybe granting more autonomy to each PSU, maybe setting out particular standards where the bureaucratic hold of the ministries can be lessened, faster procurement policies, because most of the PSUs today, as far as the manufacturing PSUs are concerned, they are suffering from technology advancement. The technology advancement that you see in a private sector and the faster pace with which a technology advancement is implemented in a private sector, you would not see that same pace in the public sector undertaking.
The upcoming election and setbacks some of Indian conglomerates have been facing lately have slowed down the privatization drive in the country. Also, the effort of changing a public sector company to a private one is Himalayan task, which requires time and effort from both the government and private companies. Let us turn our gaze to markets now. Gold jewellery retailers have been able to post strong sales in the recent quarter, even as the overall consumer sentiment remains on the back foot. As gold prices are expected to continue facing volatility ahead, will the shares sustain their strength at the bourses? Harshita Singh finds out in our next report.
Despite volatile prices of gold, select stocks of gold jewelry retailers have outshone the market recently. Shares of jewelry retailers such as Kalyan Jewellers, Titan, PC Jewellers and Thangamayal Jewelry have rallied 21 to 72% since April as compared to a 13% gain in the benchmark Sensex index. The rally has gained steam on the back of firm consumer demand for gold jewelry, aided by a 6% fall in the yellow metal from its all-time high in May. Analysts expect the uptrend to sustain on expectations of strong buying from here on in the run-up to the Diwali festivities.
The recent correction in gold prices have created a bullish scenario for the jewelry sector stocks, and the decline from the all-time high will attract the retail participation into the jewelries, which the retailers will start to accumulate post near the Diwali festival season that we will come across. Now investors considering to buy such stocks, mainly Kalyan Jewellers, TBZ, Senco Gold, which has been recently listed into the brochures, gives a good opportunity. But for short term, there can be a little bit sideways to neutral trend. But on the medium term, 2 to 3 quarters down the line, it is expected that these jewelry stocks will perform good and give a good amount of healthy returns from here, approximately between 25 to 30% at least.
The strong demand momentum was seen in the recent June quarter, with industry leaders Titan and Kalyan Jewellers reporting strong sales on the back of Akshaya Tritiya and the wedding season. Besides, the bumper listing of jewelry retailer Senco Gold last week also reaffirms investors' confidence in this space. Analysts at HSBC have raised the target price on Kalyan Jewellers from Rs 150 to Rs 200 as the company's asset-light expansion is expected to drive further re-rating in the stock. Titan remains another preferred bet among analysts, with Motilal Oswal Financial Services seeing a potential upside of 10% as it believes the company's medium to long-term earnings growth potential is unparalleled.
Titan is a blue chip stock which has delivered excellent returns in the long run. It is expensive, but it has always been expensive. Investors can expect very good returns in the long run.
Analysts believe that persistent rate hike fears will keep gold prices in check ahead, which could help the jewelry stock sustain their gains, though selective stock picking is recommended. Today, on July 19, investors will keep an eye out on the Q1 earnings of IndusInd Bank, Jubilant Pharma, Century Textiles, and Tata Communications, among others.
He's making plans for an early retirement. Business Standard.
Sensex meanwhile touched 67,000 mark on Tuesday before setting a tad lower. Markets' fear of a weak monsoon due to the El Nino effect, it appears, have been washed away for now. But rains also spell mystery for our cities, like what is happening in Delhi. Civic bodies are yet again struggling to restore normalcy, but is there a way out? The answer may be yes. Several countries are developing sponge cities now. But what are they? Vasudha Mukherjee answers. Sponge cities are urban areas designed with a permeable construction model that allows for the absorption and storage of rainwater. The objective of sponge cities is not only to prevent urban flooding but also to improve the ecology and biodiversity and address water resource shortages. These cities rely on natural resources such as lakes, grass, and soil to create absorbent ground surfaces that allow rainwater to be stored. The concept was first introduced in China in the early 2000s to address surface-level flooding in urban areas. In 2014, pilot projects were initiated in several Chinese cities with budgets ranging from 400 to 600 million yuan per city. As climate change leads to more extreme weather events like heavy rainfall and droughts, it has become crucial to integrate flood water management systems in cities. In August 2021, the World Meteorological Organization reported that around 44% of global weather-related disasters were linked to flooding. Arup, a multinational organization dedicated to sustainable development, also reported that currently 700 million people lived in places where the maximum daily rainfall had increased, emphasizing the global need to create preventative measures for flood water management. In a global report that used artificial intelligence to assess the sponginess, 7 major cities around the world, Arup gave Mumbai a 30% sponge city rating. This puts Mumbai on par with major cities like New York and Singapore. To transform cities into sponge cities, additional green spaces like parks, trees, and natural drainage systems need to be integrated. Increasing the presence of parks, greenery, and drainage systems enhances a city's absorbency and resilience to floods. Ground surfaces that mimic sponges can absorb rainwater, which is then naturally filtered by the soil and can recharge urban aquifers. The collected water can be extracted through urban or peri-urban wells, treated and reused for the city's water supply. Digital mapping tools can assist cities in identifying suitable spaces for rainwater harvesting, ponds, and inner city gardens, as well as understanding the associated risks of not implementing these measures. The World Economic Forum found that using nature-based solutions to climate change were up to 50% more cost-effective than engineered alternatives. Moreover, these nature-based approaches added 28% more value than grey infrastructure. Many cities are already embracing the concept of sponge cities by adding green spaces that provide cleaner air, wildlife habitats, and relief from urban heat. Cities like Shanghai, New York, and Cardiff have improved river drainage, created plant-edged sidewalks, and developed inner city gardens to enhance their sponginess.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
India too is taking baby steps. Chennai, Mumbai, and Kochi are planning to develop a sponge city roadmap to tackle urban flooding. Well, that's all for today. For more news, views, and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.